You can think about levels, but I think more of it is just I'd like to see a behavioral, end to this. Panic, full acceptance that the bull's over and the recession's coming. Joe, you mentioned the downward revision the market has on the Fed hikes. I think that reflects one of the things we got going on, and that is, I think, recession fears are escalating here. Yeah. And perhaps for good reason, the market message coming from stocks, the cyclical stocks across the board, everything from materials and industrials to financials to tech getting pounded. And then if you go to the commodity market, industrial commodity prices are off 10 to 15%. You go to the bond market and bond spreads, both junk and investment grade, are blowing out. You're seeing increasing concern in the market about recession. I think that's feeding through into Fed probabilities. And I think that's one of the things driving this market down. The problem we have now is it's very susceptible. You think about the Fed could stop, but what if we get a hot wage number again in a couple weeks on top of people worrying about decelerating growth? So I still think there's pressure here, but I do think we're maybe getting closer. And if I think we're going to set new lows for this year yet, maybe. And if we do, there could be wider panic, and maybe that could be a good buying opportunity at some point. I do kind of agree with that.
Yeah, I mean, without a doubt, we have not necessarily seen a kind of run for the hills moment. What's interesting about the action this week in terms of segments of the market, you talked about, Apple, Boeing. Yesterday, it wasn't just Facebook. It wasn't just the stuff with headlines. It was Adobe. It was Salesforce. It was PayPal, all down 6 to 8%. So the market is hunting for where there's still profits in these stocks. It's going for the most kind of beloved names, surrounded by a lot of certainty about the fundamental story. And, that's obviously not necessarily about the Fed, but it does show you this risk-off sentiment. So basically, you have all these excuses in the last, by the way, today's 2 months since the S&P peaked. 2 months after the S&P peaked in January, which would have been March 26th, we were in a similar spot in terms of failed rallies, kind of tropping around the lows, retesting. The difference is now the trends are broken. We don't have that earnings acceleration ahead of us. Right. So all that stuff, I think, is feeding the mix. Also, when a market does not respond to sort of favorable seasonal tailwinds, you have to take notice, right? And so that's what I think is the stew that we're all watching over right now.
Yeah, the sell-off in retail today, too.
Yeah. Another area of certainty, right? Another area that said, well, whatever else is going on in the world, the domestic consumer is fine. Well, the domestic consumer is fine, but the retail stocks were not necessarily positioned to benefit from this particular quarter ahead of what's probably going to be a good shopping season.
Right.
So Becky.
Go ahead, Jim.
I was going to say real quick on retail that, there's a really strong correlation historically between how the market does leading up to the retail sales season and what happens in the season. And certainly the decline in stocks that we've seen is suggesting we could have a weak holiday selling season. I think that's part of the reason that retail stocks are selling off. It's more about what the market message is saying about the retail shopping season.
Jim, I mean, last week we heard from Macy's, and the stock sold off, but Macy's did say that what they were seeing in the last few weeks of October was selling accelerate in a better consumer environment. How long does it take something like that to catch up? Because that's exactly when we saw the stocks really kind of crumbling.
Yeah, who's right? Who's right, the CEO or is the market? And its infinite wisdom going to be right about it? I don't know, Becky, but I would say historically,
you could see consumer shopping, but the stock's not doing well.
Right. You could, but often when the market as a whole has not done well leading up, you tend to have a disappointing holiday shopping season, and we'll have to see. I just think a lot of the market message here is very suggestive that economic growth is going to slow quite a bit. Even the Atlanta Fed GDP number now is down to 2.75% for the quarter, and maybe that falls to 2% or less. And if it does, you're going to see more people starting to move up their recession forecast, perhaps for next year.
Jim, do you think that would be the correct conclusion? What I mean by that is, if you go back 10, 11, 12 months, the market was saying, hey, we're at risk of overheating right here. The Fed's going to have to get busy. We have this global synchronized growth, and we kind of were pricing markets for that. Is there a way right now that we kind of front load recession fear and you kind of have a near miss next year and still things are fine, and yet asset prices kind of got out of whack?
That's where I lean yet, Michael. We certainly, this could be the end. We could be close to the end here, but I kind of lean that we're going to have a really deeper correction that scares all of us and convinces most players that the bear is here and the recession is here. But I kind of lean towards your view that what I think might happen at that might be a whale of a good buying opportunity, and maybe we have a couple, 3 years left and another bull run yet before this thing's finally done. The question is this 2007, where recession's right around the corner, or is it 1987, where you have a tough correction and then you still had 2-3 years left? And I kind of lean towards the latter view yet, but it's kind of a close call. We'll see.